Exclusive insights, actionable strategies, and ideas that ignite change. You're listening to the Ivey Impact Podcast from Ivey Business School.
Hello and welcome to Dialogue with the Dean, the inaugural series on the Ivey Impact Podcast. I'm Julian Birkinshaw, Dean of the Ivey Business School. On today's episode, we explore the art, science and psychology of investing. Financial markets have always been volatile, but in our current era of economic uncertainty and political instability, what some might call stock market mayhem, investors are desperately searching for sound strategies and trusted voices. To help us navigate this landscape, I'm joined by Steve Foerster, finance professor at Ivey and author of two recent books, In Pursuit of the Perfect Portfolio and Trailblazers, Heroes and Crooks, Stories to Make You a Smarter Investor. These books offer a blend of biography, behavioral finance and practical wisdom, featuring Nobel laureates, financial legends, historical intrigue and modern-day cautionary tales. Steve, welcome to Dialogue with the Dean. It's a pleasure to have you with us.
Thank you, Julian. Pleasure to be here.
Thanks. So let's get to know you a little bit better. Just to take us through your academic, your professional journey. What led you to writing these types of books?
Sure. Well, I'm first of all, I'm Ivey through and through. I first stepped foot in the old Ivey building 48 years ago, 1977, when I started my undergrad degree. Did an Ivey HBA. Went to Wharton for a PhD, and since 1987, I've been back here teaching and researching. I got interested in terms of book writing and writing stories as well. I started as the traditional academic doing the research for top-tier journals and was successful at that, but found that, as I'm sure you know with your work, the more specialized area you're in, the audience is pretty small. So I expanded and just around 2002 wrote a textbook, which was great. And these books are meant to then get into a broader audience. And when I think about our teaching pedagogy, cases, what's a case? Yeah. Case is a story. So it's just really an extension of, instead of telling stories, writing stories as well.
So you're actually one of the few faculty still at Ivey who was on the faculty when I was doing my MBA.
Absolutely, yes.
All those years ago. So exactly. It's great that you're still, hugely active as a researcher, as a writer, and I think it's completely right in some ways that you try to gradually over your career broaden the market that you're trying to reach with your research. So I think what we're going to do is we're going to dig into these two books. The first one, In Pursuit of the Perfect Portfolio, which you wrote with Andrew Lowe, who's a well-known American finance professor. I think he's at MIT.
Yes,
is that correct?
Yes.
Let's just dive in and then perhaps we come back to why did you write the book. You talk about historical versus modern investing. I guess you're just trying to remind us that there's nothing new under the sun and that investing was happening, back at the dawn of time as well. Is that right? Tell us a little bit about that.
And in fact, in the first chapter, before we get into the 10 luminaries that we interviewed, our first chapter is a very brief history of investing going back thousands of years, Mesopotamia and so on. The demarcation is really 1952. In finance and investing, we have a particular date. Prior to that date, we would talk more about the art of investing versus the science of investing. While there were some people, Benjamin Graham, for example, in 1934 wrote Security Analysis, which was a pretty thoughtful book and talked about a systematic approach for a certain way of investing called value investing. There really wasn't much of that until 1952, March of 1952, a paper appeared in the Journal of Finance, very short paper called Portfolio Selection, and it was written by one of the people we interview in our book, Harry Markowitz. And what was so unusual about that article for the Journal of Finance at the time, it had mathematical equations in it. And so this was just a very different paper. And so we can talk about...
No, let's do
Harry
that.
Markowitz,
So
yes.
Harry Markowitz, I've heard of him, but that's kind of my job. Most of the audience have never heard of this guy. And it's very unusual that an academic paper kind of has such a huge influence. So tell us what the big idea was in Harry Markowitz's famous paper.
Sure. Well, it's surprisingly simple for a Nobel Prize winning idea. And Julian, it's probably something your mother told you, don't put all your eggs in one basket. And that's what Harry Markowitz came up with. Maybe life is not fair. Why didn't your mother get a Nobel Prize for that? But what Harry did, he always told people, call me Harry, call me Harry. What Harry did was he came up with a process, a very simple but powerful process to think about risk and return. So his simple model was that what do investors care about? Two things. What's my expected return? All else equal, I would like a higher expected return to a lower expected return. And secondly, how much risk exposure do I have? All else equal, we would like to have less risk exposure than more. And so with that simple premise and also recognizing that there's a relationship between any two stocks, and we call that a correlation, covariance, taking that into account as well. What he was able to show that if we take the whole sum of securities, let's suppose there are 2,000 securities out there, he was able to show that we can boil this down to a subset of what he called efficient portfolios. And his definition of efficient portfolios, of all the choices you have out there, these are portfolios that have the highest level of expected return for a given level of risk, or flip that around, the lowest level of risk for a given level of expected return. Right. And so the key insight that he had is that there is a free lunch. There's one free lunch, and that free lunch is diversification. If you're diversified, you can improve your return to risk relationship. And that was a profound way that he did that in a mathematical setting.
So obviously we're not going to get into math. No. I wouldn't understand it. I'm sure the listeners wouldn't either. But conceptually you're saying, as an investor, all of us at some level are investing ourselves, is we should buy ourselves a diversified portfolio of stocks, and somehow the risks kind of cancel each other out. Is that the right?
Correct.
There'll always be something which is going up, something else is going down.
Precisely. Unless by chance you had two stocks that were moving in lockstep. And generally that just doesn't happen. Right. And so as long as you don't have a perfectly correlated stocks that are going exactly the same, then you get these benefits from diversification. And so, we'll transition into Bill Sharpe in a few minutes, but what Harry Markowitz said is be diversified. And that's sort of the extent. He didn't describe how to diversify, but just be diversified.
And does this mean just stocks, or does this include my bonds and my gold and my property portfolio as well?
That's a great question. And he just called these securities. And so it really is generic. And you've hit on something that's really important, because while we tend to talk narrowly in terms of stocks, really we're talking about all securities.
Right. So a U.S. Treasury is a security.
Bonds,
it has an interest. It has a yield, which is a little bit different, and obviously there's risk associated with that. Which, we'll get to.
That's a whole other story.
U.S. securities risks in a few minutes, no doubt. So Markowitz really shapes the field, because from that point on, people are bringing mathematical modeling to portfolio analysis. Was there a kind of an optimum or sort of minimum number of securities you needed to get at least decent level of
So this is where subsequent researchers did look into that, and if by definition we're just randomly choosing these, you get the greatest amount once you've diversified to, call it 20 to 30 stocks. As long as those are randomly chosen.
Right. But 20 or 30 companies in mining is not diversification, right?
Yeah.
We've got to take the entire portfolio.
Yeah.
Okay, so we'll get to William Sharpe now, who's, again, a name that some people might remember, but most probably do not. Who was William Sharpe, and what was his big idea?
Well, given that you were through the MBA program 1991, I believe,
exactly.
You were probably exposed to the capital asset pricing model.
The CAPM, as we called it in those days.
Which actually, Bill Sharpe himself calls it the CAPM. He never calls it CAPM, interestingly, a little bit of tidbit there. So what Bill Sharpe did, he actually was a protege of Markowitz. And so there was a key connection there. Bill Sharpe asked one simple question. What if we take Markowitz's model that we just described, and what if everybody acted as if they were trying to form these kind of portfolios? What would the world look like? In other words, what would be an equilibrium situation? And that's where he came up with the capital asset pricing model. He made one additional assumption. So with Markowitz, we were talking about securities, broadly defined. Bill Sharpe said, what if we could also borrow or lend at some kind of risk-free rate and combine that with all of these risky securities? So Markowitz said, of all the securities out there, there's a subset that are the efficient ones that have the best return for a given level of risk. Bill Sharpe narrowed it down to, once we combine that with a risk-free investment like a treasury bill, then there's only one of those Markowitz risky portfolios that we would all want to hold. And therefore, if we all want to hold it, then that has to be the quote-unquote the market portfolio, the portfolio weighted by market weights that everyone would want to behold. So this had a profound practical implication that it took decades, and we're still in this revolution that we can talk about. But this simple model, equilibrium model, said you should not only just be diversified, but you should buy the market portfolio. And that got both Markowitz and Sharpe Nobel Prizes.
And so for an individual investor buying the market portfolio, and we'll get into sort of tracker stocks and stuff in a second, but is actually the smart thing to do. But obviously there are many investors who are trying to pick individual stocks. Sure. Yeah. I mean, my vague memory, I'm going to look foolish in a second, was that we used the capital asset pricing model as a way of valuing individual companies. Is that right?
Yes, absolutely. And to this day, our graduates, other graduates, virtually, I'm going to go out on a limb and say virtually every MBA commerce program teaches the capital asset pricing model. A lot of graduates of programs become analysts, and they have to do discounted cash flow models to value companies. What would they use for the discount rate? It would come out of the capital asset pricing model.
Oh, I see. Okay, so we're going to talk about one more person. His name is John Bogle, before we perhaps move on to the other book. Who was John Bogle, and what was his contribution to thinking?
Yeah. So John Bogle, Jack Bogle, was a practitioner. So he was not an academic. But when he was at Princeton in the early 50s, he wrote a thesis, an undergraduate thesis, on mutual funds. And mutual funds were pretty boring kind of investment. There were a few large, fairly diversified mutual fund companies, but he put some ideas out there in terms of what mutual fund, what the direction the mutual fund industry might be. He was a traditional fund manager. He rose to the top in his 30s with the Wellington Fund. And this was the time of the so-called go-go years, not unlike the dot-com years where it was these high growth, or even more recently, the Magnificent Seven. It's these high growth stocks, and that's all that matters. His firm tried to resist, but then they were getting outperformed by these other managers. So he hired a slew of these go-go managers, and it was a disaster. It was so bad that he was basically fired from his firm, had to start all over, and had to figure out a different way, a different approach. And one thing led to the other, partly inspired by academics. He decided to start what then was the world's first index mutual fund. Rather than trying to outperform, create a fund that replicates the S&P 500 in the U.S. This was the Vanguard Fund, and took a while, but where we are now, trillions and trillions of dollars are flowing into what we refer to as passive investments.
So I do need to just push a bit here because, as you say, many people, whether they do it actively or passively, they are buying into some of these funds. And those funds and the mechanics of them don't matter, but essentially they are created in a way that they will more or less mirror the S&P 500.
Correct.
Or whatever it is. And we know that in the long term, that will be a very solid investment.
Correct.
And yet there are hundreds of thousands of people out the world running active funds, and they are basically asking investors, people like you and me, to give them essentially 2% or whatever the fee is, for the right to chance their luck with beating the market. The evidence, almost by definition, is that while some of them do, some of them don't, and that they shouldn't have bothered. So how does that active fund investment industry, which is many of our graduates, how does it persist? I mean, why don't we end up with more and more of the world just simply playing the passive game?
Well, the trend is clearly and has been in terms of the passive world.
Right.
Is a winning world, and so that has grown tremendously. It is admittedly much tougher to be an active manager now, and as you point out, the big difference is in terms of costs.
Right.
Vanguard really led the way, continues to lead the way in terms of bringing down those costs. So for these passive funds, so it's minuscule. It's only a few fractions of a percent. So even if the active managers are charging 1%, that means they have to outperform by more than 1% to recoup those. And actually, Bill Sharpe has a delightful, very short but famous paper called The Arithmetic of Active Management, just the logic you described. If active managers, if that's more costly than passive, collectively, after fees, they have to be doing worse than the passive managers. So why are there still active managers? You have to believe that I know how to pick those active managers who are going to outperform. I know the Warren Buffetts. Well, we can look at Warren Buffett as an exception. But the challenge is, Julian, can you name who is the next Warren Buffett and who will be that person for the next 30 years?
If I could name that person, I'd just be buying in, and
you wouldn't be telling our audience.
Exactly. No, I mean it's such a well-known paradox that perhaps we shouldn't spend any more time on it. But it seems to me that we do need, of course, some people, of course, who are actively trying to beat the market. Otherwise, the market doesn't work.
You're absolutely right on that. And there have been a lot of theoretical discussions of that. If everyone went passive, we wouldn't have a functioning market because thanks to the active managers, they play an important role in terms of incorporating new information that they find through their work.
Right. So we actually need these people beavering away, trying to, as you say, come up with new theories, new reasons why Tesla is, overvalued, although I think we all know that is the case. But getting the timing is the challenge, so that others can then form their own opinions and stocks can eventually find their right level, I guess.
Correct.
Right. Good. So just before we finish on that book, I mean, you actually interviewed these people yourself, right?
Yes, myself and Andrew Lowe, yes.
So, I mean, just a quick insight into you're dealing with people who've become, within their industry, world famous, but these are just humble academics like you and me, I guess. What were they like? Perhaps some were, perhaps some weren't.
Some are more humble than others, I would say. To a T, they are some of the brightest people that I've met. What's fascinating, I think, in terms of what are some common elements, it's amazing, especially among the academics, how they got into the area that they got into. And luck, serendipity played such a big role. Harry Markowitz, to give a quick example, was struggling in his PhD program in an area called operations research, what we would now call management science. Wasn't sure of a topic, so he went to see his advisor. He knew the tools he wanted to use, linear programming and so on. His advisor was busy, so he was sitting in the anteroom waiting for his advisor. Another person was waiting for his advisor. Anyway, they got to talking. This person happened to be the advisor's stockbroker. So when Markowitz went in to see his advisor, he said, well, the guy out there said I should apply these techniques to the stock market. What do you think? And that's how Markowitz got into this. Wow. So it's so much serendipity in all of these people.
Beautiful. So let's turn to the second book, Trailblazers, Heroes and Crooks, Stories to Make You a Smarter Investor. And I actually read some of this, and there's some fairly quirky stories in here. I mean, it's a little bit of this, a little bit of that, which is kind of fun. We'll just pick up on a couple of them. So Ronaldo and Coca-Cola.
Sure.
Just tell us what that chapter's about.
Well, a lot of your viewers might be familiar with this event that took place in 2021 at the Euro Cup. Ronaldo, of course, the big star, was at a press conference. Coca-Cola, big sponsor, and there are 2 bottles of Coca-Cola prominently displayed as you would have it at these press conferences. Ronaldo comes in, sits down, takes these 2 bottles, puts them out of sight, and then says, "Agua, no Coca-Cola. Drink water. Don't drink Coca-Cola." And this is a major sponsor.
Yeah.
So the headline of Washington Post and others the next day was Ronaldo snubs Coca-Cola. Stock drops by $4 billion that day. So the story was about Ronaldo, who actually to this day is the biggest, has the most followers on Instagram. 500 million followers on Instagram. So the story was, look at these influencers and what impact they would have. Turns out that's not the story. That's not the real story. So did the stock lose $4 billion in value that day? Yes, it did. But it had nothing to do with Ronaldo. There was an actual technical reason having to do with an upcoming dividend that Coca-Cola had announced. And if you own the stock on the Friday, this was a Monday, you get the dividend. If you buy it on the Monday and afterwards, you don't get the dividend. So naturally, this happens all the time. The stock falls by approximately the amount of the dividend, right? And all that happened before the press conference. And so, in fact, Coca-Cola stock went up the rest of the day after that. So the whole theme and the lesson from that story is, let's not confuse correlation with causation.
Got it. And so when we see big stock market moves, I mean, we always want to kind of make sense of them.
Yes.
We want to provide a cause and effect story.
Exactly.
But you're saying a lot of this is nonsense, basically. Is that right?
Well, it certainly makes for a much better headline to say Ronaldo snubbed Coca-Cola, the stock dropped, versus Coca-Cola had an ex-dividend day and the stock dropped is not an exciting headline.
I remember that book, Fooled by Randomness.
Yes.
That was, again, a similar sort of approach. You've got a chapter on masterly inactivity, the wisdom of doing nothing.
Correct. Yes. Yeah.
Again, let's explore what that means.
So masterly activity is not about laziness. So the term really is the art of knowing when to do nothing. And it goes back to 2 centuries BCE with a Roman dictator, Quintus Fabius, and he had the unenviable task of trying to stop Hannibal, who was bringing his elephants across the Alps and taking territory in Italy. When Hannibal met up with Fabius, he tried to draw him into battle, but Fabius knew that he wasn't quite ready, so he chose to do nothing when Hannibal was trying to say, "Okay, let's fight," and he just didn't engage, and he waited and timed things once he had built up enough force, and then surprisingly defeated Hannibal. So that's one example. Another example in the sports realm, in boxing, probably the world's most famous boxer, Muhammad Ali, 1974, the famous Rumble in the Jungle against George Foreman.
Yep.
At the time, Muhammad Ali was a has-been. He was way past his prime. Foreman had knockout after knockout, and the odds were something like 40-1 that Foreman would beat Ali. What did Ali do? This was the famous rope-a-dope, where he just protected himself, went against the ropes, absorbed all the punches until Foreman was exhausted, and then he knocked him out. So this was a classic masterly activity.
And so this then plays into the world of investing.
Correct.
In other words, and perhaps we can bring it to the present day briefly, but when you see all this frantic stuff happening in the market,
Yes.
You don't know whether Donald Trump's going to raise or drop tariffs, just ignore it. And basically wait for that noise to go past. Is that right?
Exactly. And in investing, it goes back to Jack Bogle. And buying and holding an index fund might be boring, but it's masterly inactivity. It's doing nothing. And Bogle had a famous saying, when the markets are going crazy and your broker calls you and says, you've got to do something, he said, well, tell your broker that don't just do something, stand there. So meaning masterly inactivity.
No, I do have a few friends who are brokers, investing somebody else's money usually. And it's remarkable how little work they ever seem to do. But of course, they are working by monitoring what's going
Absolutely.
on. And then they learn when to make that big decision, to make a trade, to buy, to sell, whatever. Yep. Beautiful. It sounds like a good way of earning a living, actually.
Yes,
so
absolutely.
One more from the book, The Power of Keeping Emotions in Check. Say a bit more about that.
Sure. I mean, there's a few different ways we could go with this. Actually, one that I'll talk about is Sir Isaac Newton. Back in the 1720s, what people don't know about Newton is he was big in investing at the time, and the one hot stock then was the South Sea Company, and Newton had invested in the South Sea. Stock price went up. He made a ton, and he sold. He made a huge profit, the equivalent of at least hundreds of thousands of dollars, if not millions of dollars. South Sea stock, after he sold, kept going up. Newton had one of the earliest documented cases of FOMO, the fear of missing out. So what did he decide to do? He decided to get back in and buy back into South Sea, probably at the worst time, right when it was at its peak. Its stock had gone up by 10 times in about 6 months, and it just dropped right down after that. So this is a classic case of we've seen this more recently with meme stocks. Keep your emotions in check. Just because everybody else is going after this fancy new thing doesn't mean you have to.
So when your friends are making a fortune in Bitcoin, don't do it, basically. Correct. Yeah. Okay, look, let's take all this back to the present day. And, we live in a time of absolute chaos in the markets where, one person's utterances, moves the markets by huge amounts. We've made the very important, simple observation that the smart investor at the moment is probably just sitting on the sidelines and watching. But what more can you say in terms of how we make good investment choices through this period?
Sure. So the common theme to both of those books is that it's important for all investors to come up with their own investment philosophy. So, for example, my investment philosophy might be that either I believe or don't believe in efficient markets. If I believe in efficient markets, then I think that it's hard to beat the market. Therefore, I'll just buy and hold an index fund, right? So that's an example of developing your own investment philosophy. You might try your stock picking and you might learn from the lessons from that. But whatever it is, and try to make that investment philosophy evidence-based. And that's why I try to tell some stories, so at least if you're not investing, you can be aware of what happened on October 19th, 1987, where stock market dropped by over 20%. So that's one thing. The second thing, let's go back to Harry Markowitz. Diversification is so powerful, not just diversifying within stocks, but across different asset classes as well. We talked about bonds and other different kind of assets. Another thing is investing for the long term. That's really important. And the last thing would be to check your emotions, watch what biases that you would have.
Look, we must wrap up. I hear you're working on a new book. Just tell us briefly what that is.
Sure. It's a really fun project. It's the authorized biography of Bill Sharpe, who talked about the capital asset pricing model. So it's a delightful story, because his story is really the story of investing, and it's going to be a life and times, so it'll be a story about investing. And maybe I'll give you 4 things that graduates of our program and other programs who have taken finance and know about the capital asset pricing, what do they not know about Bill Sharpe? Bill Sharpe is an amazing jazz musician. Used to play the bass, so he got started in that way. He's the co-founder of a company that originally called Financial Engines that went public on NASDAQ and at its peak was worth something like $2 to $3 billion. Not many Nobel Prize winners found successful companies like that. In 1959, he co-authored, while he was at the Rand Corporation, he co-authored a paper, one of the first papers to come up with the idea of a carbon tax.
Oh, wow.
Yeah. It was trying to deal with the smog problem they had in the Los Angeles basin. Huh. And the last thing, he has a colorful ancestors. He had one ancestor, Jonathan Buck, who founded Bucksport, Maine, who legend has it, and I'll tell more of the story in the book. And again, I want to stress this is legend, that Jonathan Buck may have had a mistress who he accused of being a witch, who burned her at the stake, and she came back and put a curse on him. And so that's a colorful story. I don't know whether you have ancestors as colorful as that, but
not that I'm aware of, that's for sure. And this is authorized, meaning you are interviewing him,
so yes,
family and his friends and stuff like that.
Yeah, just a delightful person.
Wonderful. Look, we must wrap up now. Thank you very much, Steve, for your time today.
It's been a pleasure.
Thanks. You've been listening to Dialogue with the Dean from Ivey Business School. A big thank you to my guest, Steve Foerster, for sharing his time and insights. And of course, thank you for tuning in. Until next time, goodbye.
This was Dialogue with the Dean, an Ivey Impact podcast series. For more insights from Ivey, including thought leadership on critical issues and additional podcast episodes, visit ivyimpact.ca or subscribe on your preferred podcast platform. Thanks for tuning in.